Okay, so we just got done talking about the discounted dividend model, the present value of all future dividends brought back to a price today. The next method is constant growth stock, a stock where the dividends are expected to grow forever at some kind of a constant rate, whatever that rate we determine to be. And you can see down here the formula basically is the dividend a year from now divided by the rate of growth divided by let me say it again. The dividend a year from now divided by the rate of return minus the growth is the price of the stock today. So future dividends and their present values, what this chart shows us is that as dividends go up, then the present values are brought back down to today's value. So what happens if the growth of a dividend is greater than what if the G, the growth rate, is greater than the rate of return on the stock? The constant growth formula leads to a negative stock price, which does not make sense. The constant growth model can only be used if the required return, the rate of return on the stock is greater than the growth, if growth is expected to be constant forever. So it can't be used for all situations. So it can only be used in certain situations where we have a dividend growth at a certain amount or a certain rate that's constant forever. So just a few stocks can use it. In the chapter, you'll see some information about the SML, which is the securities market line. We use that to calculate the required rate of return. And so the return on the RF is the risk-free rate. The R sub M is the market rate of return. And the beta for a stock is 1.2. Now we haven't really gotten a whole lot into beta, so we should talk about that. Beta is a measurement of risk. Basically, if we're going to take on more risk to get a greater return, we need to measure that risk. And so the stock market's beta, just the beta on the market as a whole, is 1. So a stock that has a beta above 1 has more risk than the market. And so what they're saying in this example is if the risk-free rate's 3 and the market rate is 8, and we have a stock with a beta of 1.2, we want to get the right return matched up with that amount of risk, which means that we should get a rate of return of 9% to match that risk. Okay, so it's basically what they're saying is with a beta of 1.2 and the risk-free rate of 3 and the market rate of 8, that the rate of return on the stock to have the stock interest, the stock return, and the beta be the same. When this one, it says just to find the expected dividend stream for the next 3 years and their present values of the present value of some dividends. So it says here if dividends today are $2, D0 is $2, and the growth is constant at 4%, what will future dividends be? And we're just doing this basically. You can get 208, 21632, 224, 4973. We bring those all back to present value using that 9% rate that we just got done coming up with, basically saying the rate of return that I need with a beta of 1.2 is 9%, and so I'm using that 9% to compute the present value of all my future dividends, at least the next 3 years worth of dividends. And so what I can do then is compute the stock price by saying the dividend a year from now, 208, which is D0 times 1.04, so it's 208. I divide that by the difference between my required rate of return of 9 minus my growth rate. And see, remember, if the required rate of return is less than the growth rate, this model won't work because you get that negative stock price. That's what they're trying to tell us a couple of screens ago. So the required rate of return has to be greater than the growth rate, or else this model doesn't work. And so we do this and we get a price of 41.60. What's the expected value 1 year from now of this stock? So what we can do then is just do D sub 2, which is 216. So D1 will have been paid out, so then another year goes by. So 208 times the 1.04 we get 216.32 divided by the 0.09 minus the 0.04, and the stock price goes up just a little bit because we've got one more dividend stream coming back to a present value. So now it becomes 43.26. Dividend yield is just simply the dividend divided by the price of the stock. So in this example, we're saying D1, the dividend a year from now, 208 divided by the price of the stock now is 5%. So that's my return on dividends on that stock. And the capital gain yield is the difference between what the price a year from now will be versus the price today divided by the price today. So that difference, that gain, divided by the price today, and we get a 4% capital gain yield. And my total return is that same 9% that we used before. Part of that return is dividends, part of that return is capital gains, because the stock price continues to go up based on the increasing future value of, the present value of future dividends that are received. So it says here, what would the expected price today be if the growth was 0? Basically, if we just say dividends are $2 and we don't expect them to ever change, what would the price of the stock be? And so this one's not too bad. It's a very simple one. Of course, we computed that the required rate of return on the stock is 9%. So we just take 2 divided by 0.09, we get 22.22. So we don't have that growth to factor in here. We just have the price, the dividend divided by the return, we get 22.22. Supernormal growth is a little bit different. What if the growth is 30% for year 1, 20% for 1 year, and 10% for 1 year before achieving a long run growth of 4%? We could not use the constant growth model. However, we could use it after the constant happens after 3 years. So we could still use this model to a degree. The next slide just shows us what we need to do. We just need to go, if the dividend today is 2, and we've got that 30% growth, then 20%, then 10%, then we go just a normal growth rate of 4% thereafter. We have to bring these first 3 years, we have to bring their dividends back to a present value. And then we plug in the constant growth model over here at P3. So at P3, we use the constant growth formula, and we get 71.39, and we bring that down to a present value today. We sum those all up to get what the price of the stock should be today. So you can still use that model. It just becomes a little bit more difficult to use. Find expected dividend and capital gain yields during the first and fourth years. So really what this is saying then is what is the yield based on dividends versus capital gains. You can see what they're doing is they're taking that 260 number that was right here, D1, divided by the 62.78, we get 414, and then the 62.78 was the sum right down here. And then we do the capital gains, which is simply, we just know that the required rate of return is 9. So we know that if the dividend gain was 414, that must mean the capital gain is 486. During the non-constant growth years, dividend yield and capital gains yield are not constant, and capital gains yield will not equal the required rate of return. After T3, though, then they will become constant. So this is another example that it just basically says, what if we have 0 growth for 3 years? Then we go on to go for this a normal growth of 4% after that. And so we just bring these 2's back down to a value today, and then we do the 208, the D1, divided by the return minus the growth, and we get the 4160, bring it down to a present value today, and we get 3719. And again, we can do the same calculation. Take the 2 divided by the 3719 to get the dividend yield, and the difference then becomes the capital gain yield. Then after that, it just becomes dividend yield is always 5 and capital gains yield is always 4. If a stock is expected to have a negative growth rate, would anyone buy the stock, and what is its value? And the answer is yes, you'd still buy it. Even though the dividends are declining, as long as the stock is still producing cash flows, it should have a positive value, which it still does. So even if dividends are going to go down, there still is value to the stock, and somebody would buy the stock. And you can just see here the calculation. D1 becomes 192 because now my dividend goes down by 4%. And then down here, I've got my required rate of return of 9 minus a minus, basically. And so it becomes 13. So my stock price goes is pretty low, but it would still be somebody would still buy it. So my capital gain yield is a negative, but my dividend yield is a large positive. So dividend yield is offsetting capital losses, basically, is really the way to think about that in this example. Okay, so of course dividend models can only be used when a company pays dividends, and not everybody does. So we have to look at some other models also. And the corporate valuation model is one based on free cash flows. It's also called the free cash flow method. It suggests that the value of an entire firm equals the present value of all firms' free cash flows. Free cash flow is your after-tax operating income less your net capital investment. In other words, that net capital investment is what you need to reinvest in the company to maintain your current levels of production, right? Just the theory behind that is as you use machinery, as you use property, plant, and equipment assets, as you use up any long-term asset, things wear out, right? So at some point they have to be replaced. So what we're doing is we have to factor in just the normal rate of replacement of property, plant, and equipment items plus just any changes in net operating working capital, which is my current asset minus my current liability. So the free cash formula is right here. FCF is free cash formula, and that is my EBIT, my earnings before interest and tax, multiplied by 1 minus my tax rate. So we basically have our operating earnings after tax, plus we add back depreciation and amortization because those are non-cash items. So my EBIT would include a reduction by depreciation and amortization, but we add those back because they do not represent cash. And then we subtract capital expenditures plus whatever change, so the delta of the triangle means change in net operating working capital. Okay, so that's how we compute that formula. So the free cash flow method is just, normally is kind of plugging in some of these numbers, which is what you'll be seeing when you do the Applia problems. So to find the market value of a company, we find the present value of all future free cash flows. We subtract market value of debt and preferred stock to get to the market value of common stock. We divide the market value of common stock by the number of shares outstanding to get an intrinsic stock price or a value per stock. Basically, a value per share of common stock is the way I should say it. Often preferred to the discounted dividend model, especially when considering the number of firms that don't pay dividends or when dividends are hard to forecast. It's similar to a discounted dividend model, and it basically assumes that at some point free cash flows will grow at a constant rate. We have what we call the horizon value, represents the value of a firm at the point that growth becomes constant. So we have to put in some assumptions, which means this is, it's hard for anybody to nail this number down to an exact number because there's always estimates that we have to put into these. And again, different reasonable people could have very different reasonable assumptions about what those estimates should be. And so right here is just an example of the timeline of cash flows for a company. It says use the corporate valuation model to find the firm's intrinsic value. And so we're going to go with a required rate of return of 7. We're going to, at some point here, go to a constant growth of 5%. And we're going to have what they call the WACC, weighted average cost of capital, which is 7%. Okay, so 7% is my right here, my required rate of return. And we haven't talked about the WACC in detail yet. We will. Weighted average cost of capital is the WACC. Basically, the cost of having debt and equity on the books. There's a cost to that, and the weighted average cost of capital combines both of those into one number, debt and equity. So basically what we're saying is the cost of this company to have equity is 7%. And it's different for every company. They're just going to give it to us as we compute these in this chapter. In future chapters, we'll try to compute what the WACC is. In this chapter, they're just giving it to us. So you can see here for this company, you have a negative cash flow in year 1. In year 2, it's positive. In year 3, it's positive. It doubles between 2 and 3. Then we're saying it's going to just increase at a 5% constant growth after that. And so for years 1 and 2, all I can really do is just bring those back to present value. So basically what I'm doing is I'm taking the present value of -5 down to 0, just at one point at 7%. And then for the second year, I'm doing the same thing down to 0, 8.734. And then years 3, 4, 5, and so on, I'm just assuming a constant growth. And I can put in my constant growth formula down here, which is exactly the same formula I used when I did my dividend model. Is I'm looking at what my P0 basically is 20, but then P1 the next year is 21, so 21 is my formula, and then my growth is 7 minus my required rate of return is 7 minus my growth of 5, and that gives me what my cash flow is. That's the horizon value, the point at which the growth is constant. So I bring that down to a present value of 857, and so I sum up all these numbers, and so what I'm saying is that the value of this company is 877.5. Okay, now that's not per share of stock, that's just in total. And so what we can say is the firm has 40 million in debt in preferred stock and the 10 million shares of common stock. So what I have to do is take that cash flow of 877 and subtract the debt and preferred. Okay, so what I'm saying is the market value of equity is the 877.50 minus the market value of debt and preferred shares. Okay, those come away. So I subtract those, I get 837.50. I divide that by the 10 million shares, and what I'm saying is that the value of the stock should be 83.75. Okay, and I of course would then compare that to the price of the stock was trading for, and I can make a buy and sell decision based on that. So now it's never that simple, right? So I'm guessing the future. I'm looking at today. I'm over here in time 0, and I'm guessing all these future cash flows. I don't know exactly what they are. Just this is what I believe they will be. And I don't know if the growth rate will actually turn out to be 5% or a different number. I should have you can get a pretty good handle on what the WACC is, but I'm still predicting the future. So that makes it sound like it's really easy to find out what the price of a stock is and make a trading decision based on that. But we had to guess so many things to get down to that 83.75 number. This makes it look like it's really easy, but because they're just giving us the numbers. But just know that in reality, we're guessing all this stuff. We're guessing the percents. The percent of growth, we're guessing what each individual cash flow is. Okay, the next method is called firm multiples. Analysts use the following multiples to value stocks. So the PE ratio is price to earnings, or price to cash flows, or price to sales. What we're saying is what's the stock trading for, what's the price on the market, divided by either earnings, cash flows, or sales. And then that gives me a multiple of earnings, a multiple of cash flows, or a multiple of sales. Based on comparable firms, estimate the appropriate price to earnings ratio, multiply this by expected earnings to back out an estimated estimate of the stock price. So we're trying to just guess stock price by doing this. The EVA approach is economic value added. What they're saying here is equity capital times your ROE minus your cost of equity. That should get us down to a number or value per share. So basically we get to market value of equity equals book value of equity plus the present value of all future EVAs, which then turns into the value per share, meaning the market value of equity divided by the number of shares. Preferred stock is a hybrid security. It's preferred. The word preferred means it's preferred for dividends. Like bonds, preferred shareholders receive a fixed dividend that must be paid before dividends are paid to common shareholders. And they have a fixed amount that cannot change. Okay, so with a common stock, there's no limit, there's no cap on the amount of dividends that you can receive as an investor, but with a preferred stock there is. It's capped at a certain amount. Companies can omit preferred dividend payments without fear of pushing the firm in bankruptcy, which is kind of a key thing in why some companies will issue preferred stock. Because if you don't have the cash to pay dividends in your preferred stock, the shareholders cannot force you to do it. Okay, if you stop paying interest on your debt holders can force you into bankruptcy and force you to liquidate to pay them back. So it's a key difference between preferred stock and debt. And then it says here, if a preferred stock with an annual dividend of 5 sells for 100, what is the expected rate of return? These are pretty easy calculations. Again, because the dividend amount never changes, we just take the 5 divided by the $100 and we get 5%. So basically the return in this stock is 5%. I think you'll find that stocks are a little bit easier to work with than bonds as you do the homework in Aplia. Just my guess. And then I've got the Excel for the chapter open. Again, it's always just good to look at this. There's many examples in the book where they kind of take this exact file and they put it in the book. So they show us the discounted dividend model first. They're showing us what the formula is. They're showing us the formula then for the constant growth model, the D1, the dividend a year from now, divided by the required rate of return minus the growth. And that's basically is what the stock should be trading for today, what the value of the stock is today. So they're giving us an example of that down here. You can see here they just did a formula here to compute that. With the dividend is today the growth of 4%, the required rate of return of 9%. We're saying that stock should be worth $20.80. So the formula is right there. They just basically compute the formula for us over there. Then they do an analysis here of stock price sensitivity based on dividends changing and how that impacts stock price. So just kind of more of an FYI with that one. And then of course, as we have a growth rate, what's the expected rate of return? And how do we break that return into dividend yield versus capital gains yield using the same data that we used up above and also the same numbers that were actually in the PowerPoint. And then to give us an example here to value non-constant growth stocks. It's a little bit more challenging to do those because we have to bring these separate dividend payments back to today's value until we get to the terminal value, which is where they go constant at a certain rate. Okay, so just showing us again what we showed in the PowerPoint, but it's always good to see an exact example. So you could definitely plug some of these numbers. You can use this Excel to compute some of your Aplia problems as you have to work on these. You can definitely just substitute the numbers that are here for your new numbers in the Aplia problems. Then the preferred stocks are right here. Really easy to do the preferred stocks. Those are very easy calculations to do. So showing us what those are. So I think you'll find that those are pretty easy to follow. Then they also have just some tables that show constant growth stocks, just how their prices will change over time. And then as usual, they've got some answers to the self-test questions are in here also for Chapter 9. So I think you'll find Chapter 9 just to be a little bit more straightforward than some chapters. But as always, if you have questions, just